Hello everyone, and welcome to FinWiser Advisory. In this course, we will be talking about financial modeling, DCF and comparable valuation. This course is divided into 16 modules. We are building a financial model on Tesla Motors. In Module 10, we will cover equity and reserve account. In this module, we will understand what is equity reserve, extracting the historical data from annual reports, creating placeholders for forecast period, calculating values in the forecast period. We will be using Microsoft Excel. In this template, there are two sheets named as Control Accounts 1 and Control Accounts 2, which, step by step, runs the user on how to calculate interest income and expenses. Historical income statement, balance sheet and cash flow created in the previous modules are available in this as well. Once the user completes a module, the final outcome of that is available to be used in the next module. Now, let's get started. The equity account in a balance sheet represents the ownership interest of shareholders in a company. It is the residual interest in the assets of the company after deducting liabilities. Here's a breakdown of the components typically found in the equity section of a balance sheet. 1. Common stock represents the ownership shares issued to shareholders. It is usually listed at the par value of the shares. 2. Additional paid in capital represents the amount shareholders have paid for the stock above its par value. It's the extra amount investors are willing to pay over the nominal value of the shares. When a company issues new shares, the issue price is divided in two parts. A. Face value. B. Share premium. Funds received on face value is added to the common stock account, row 91, and premium amount is added to the additional paid in capital account, row 97. Let's look at this with an example. If a company issues 10,000 shares at $100 per share with face value of $10 per share, then 1. Addition to common stock, row 91, will be added $100,000, 10,000 share times $10, that is, face value. And 2. Addition to additional paid in capital, row 97, will be added $900,000, 10,000 share times $90, that is, premium over the face value. Retained earnings account. Retained earnings are the cumulative net earnings or profit of a firm after accounting for dividends and are sometimes referred to as the earnings surplus. These are the net earnings after dividends that are available reinvestment in the company's core business or to pay down its debt. It is recorded under shareholders' equity on the balance sheet, row 41. Retained earnings for a specific period is calculated by adding net income or subtracting net losses from beginning retained earnings and subtracting any dividends paid to shareholders, cell B111 to B114. For instance, in 2014, 1. Opening balance of retained earnings in cell G111 equals to closing balance from previous year, that is, cell F114. 2. Profit or loss for the year in row 112 is sourced from income statement row 29. 3. Dividend paid for the year in row 113 for historical period is sourced from cash flow from financing section, cell D48 to F48, and for forecast period is calculated based on dividend payout ratio and available profit for dividend distribution. Dividends. A dividend is a distribution of a portion of a company's earnings to a class of its shareholders. Dividends can be issued as cash payments, as shares of stock, or other property. The formula to calculate dividend paid is profit or loss for the period, row 117, times dividend payout ratio, row 118. That's all for now. See you in the next module. Have a wonderful day.